that's been real popular lately, people refinancing and talking about what's a good mortgage for them. And I want to compare and contrast two loans, two terms called conventional mortgage or conventional financing and FHA, and clear up the difference between them, some of the misconceptions. Mortgage guys tell us all the time, again, whether bank or broker, they hear so many different misconceptions and ideas, and give you as a consumer, you as the people, I guess some tools, I always say some ammunition, to go out and find out what's a good deal and what's a good loan for us and what would fit in our scenario. But the first misconception I want to clear up about FHA is I hear this myself all the time, and I have a lot of mortgage people report to me that hear this all the time, is simply this: Andrew, FHA is just a first-time buyer mortgage. I can't get it. A, I make too much money. B, it's my second home. Guys, you need to get that out of your head. That could not be further from the truth. FHA you can use over and over and over and over again. Going back to how to compare and contrast and find out what's the best and the best situation for you would be for you just to kind of look at what your loan to value is. Where's it coming in? Conventional monies, conventional loans, a typical 30, 15, 20, 25-year fixed mortgages are typically bought by the tail-end investor called Fannie and Freddie Mac. And Fannie Mae and Freddie Mac have been in the media a lot lately. They buy all tail-end mortgages. Okay? They put some pretty hard rules in place over the last little bit. It's no secret they've gone through some horrible situations, but nonetheless they got some pretty steady rules right now. And simply, for the most part, cannot go above 80% loan to value on anything that's cash out, meaning you're trying to ever pull money in your home to pay off various debts or send a kid to college or so on and so forth, all kinds of different other examples. FHA has become the strong one for that because they're one of the only mortgages left out there other than VA, a veteran mortgage, that allows for you to go up to 80 to 85% loan to value. Okay? Now both of them, whether you're above 80% or 85% loan to value, you're going to carry what you call mortgage insurance or private mortgage insurance. Now I'm not going to go deep into that. We'll make another video about that, explaining what that is, what that entails, the tax deductibility of it. Is there even any tax deductibility of it, and how does it benefit me for using that? Because that is one other big misconception, that, Andrew, I don't want to pay that. It gets me no benefit from doing that, and that's just not necessarily true as well either. So both of them are going to carry if they're above 80% loan to value, but FHA's and conventional as of 2007 January, in fact, it's 100% tax deductible depending on your income. If you make under $110,000 and it tiers down, you're able to write off that mortgage insurance month to month. Anyone who makes over past $110,000, null and void, you can't write that off. Okay? FHA, conventional, both similar interest rates. They're both driven by different indexes, different on the bond market as well too, which we'll send out a video on how that works. And they both have very aggressive, very simple, easy to understand interest rates. Just like conventional, FHA's got 30 years, 15 years, 20, 25 years, so on and so forth. One of my most favorite things about FHA that's allowing a lot of people to do, and again, it's not a big secret right now, there's a lot of people that don't have a whole lot of equity in their homes. So calls, emails, comments all the time about what loan could fit my needs if I'm at 95% loan to value or 94% loan to value. FHA has been the flagship for that. They allow for you to actually do what you call a rate and term, which a lot of people should be looking into doing right now, getting a better rate, a better situation, because rates are as low as they are right now. So only one that allows for you to go up to 97% loan to value, 97.5 to be exact. That's right, a higher loan to value, a better interest rate, a better situation. Conventional, they have something they call a DU Refi Plus. You have to be owned by Fannie Mae to even look at doing that, which a lot of people are owned by Freddie. They only go up to 90 or 100 plus, and they're a little bit more, I should say, a lot more difficult from what I hear to get done. So FHA, conventional, while they're both great mortgages, what really is going to help you determine what works best for me. Hey, you don't have to be a first-time buyer to have FHA. It doesn't matter what amount of money you make to do FHA. We have to just make sure that depending on what the loan to value we're thinking at is going to help us place into what's a good, solid mortgage for us.